Vamakshi, stay with us because M&M Finance also came out with their numbers, and it was a weak set of numbers that was reported by the company. The NII, the PAT, NIMs, that they all were below the street expectations. But the management is expecting the NIMs to rise by the end of FY24. So give us more details on the results coming in from M&M Finance.
Yes, a weak show is what M&M Financials posted this time around. Yes, the company reported weaker than expected numbers as far as the NII, NIMs, PPOP as well as the net profit is concerned. And let's look at some of the factors that are actually driving the company's weak performance. Let's first start off with the most important factor, that is the NIMs. They were impacted by almost 20 basis points sequentially, a double whammy coming here because on the asset sides, yield did decline by almost 33 basis points sequentially, and that was mainly on account of a couple of factors such as the higher share of dealer funding, mainly owing to the festive period, as well as higher growth in auto UVs, which is a lower yielding segment, and that is mainly on account of higher competitiveness in this segment. Whereas when we look at on the liability sides, the management was actually expecting that the borrowing cost could actually start reducing for the company around the festive season, but instead the borrowing cost actually rose by almost 10 basis points sequentially. So all in all, that did create an impact on the NIMs, but the management is hopeful of a NIMs recovery to almost 6.8% by the end of FY24, and in fact they are expecting it to reach 7% by FY25 as the company is planning to take some hikes in the portfolio, as well as increase the share of pre-owned vehicles in the portfolio, which is a relatively higher yielding segment. Apart from that, another factor that actually impacted the company's numbers were the credit costs. They came in at almost 2.3% on an annualized basis, and this was much higher than the company's own guidance of around 1.5 to 1.7%. But nevertheless, the management is appearing to be quite confident of bringing back the credit cost to that level. In fact, the spike in credit cost actually led to the company missing its estimates on the net profit front. Apart from that, the company also toned down its growth guidance. AUM growth was almost at 27% this time around, which was driven by 32% increase in cars as well as the auto portfolio. But the management has in fact toned down its aspirations to nearly 20% as compared to 25% earlier. So all in all, yes, a weak show, but nevertheless the management did sound quite confident on the future outlook. They also highlighted that the second quarter performance could be mainly on account of seasonality factors, and apart from that, they're expecting an improvement to come in the quarters ahead. But as of now, the stock could be under pressure on account of a weak set of numbers.